Happy Friday. Hi, I'm Mike, Chief Investment Officer here at Lighthouse Financial Services, and I'm here with another edition of our monthly market update. So I'll show my screen. It's May 13th, so we're halfway through May, and a lot has happened since late April when I appeared before you last. Okay, so let's talk about the state of investment markets as they stand. Now, today's a great day, but man, the first half of 2022, significant correction. The Dow bottomed out yesterday, down 15%. The S&P 500 down 20%, and the Nasdaq, which is kind of tech heavy, down 30%. So this is significant. Approximate causes, again, hasn't changed since last time. The Federal Reserve is pushing rate hikes to fight high inflation. That's the whole idea. And that has turned investor sentiment very sour. Then you throw in a couple of other ingredients into this inflation stew, like the Russian invasion of Ukraine and China's COVID shutdowns. The entire city of Shanghai is shut down, and voila, you have a correction. Meantime, and we'll talk a little bit more in detail about this, the economy is still expected to grow about 3% this year. Those estimates are coming down a little bit, but still about 3%, and then 2% next year. That's positive growth. Inflation is supposed to peak this year, and we may be seeing that peak right now. Consumer spending is holding up. The expectation is for about 3% this year, which is considered healthy. And hey, it's hard to ignore the fact that the labor market is pretty strong. Unemployment is really low. People are finally starting to go back to work. Those who were kind of structurally unemployed during COVID because they couldn't find childcare or they were uncomfortable, with the risk of the virus in the workplace. So the economy is holding up pretty well. Let's talk about the fact that stock prices are falling. This is unavoidable. I mean, this is the biggest correction you can see in this chart on the right-hand side. Biggest correction that we've had since COVID in early 2020. So this is pretty significant. Now we're still nowhere close to where we were pre-COVID in 2019. We're still much higher than that. But the market is clearly in downtrend, and what that means, stocks are getting cheaper. And so it's like, no downturn goes to waste. Well, eventually assets, when they're falling in price, if they're quality assets, they get to look so attractive that people start buying them up. And maybe that's what we're seeing today during Friday's session. So this is a chart of the price earnings ratio on the S&P 500. It's a measure of valuation, how expensive or cheap the stock market is. And you can see the high point in this chart, the PE ratio was about 25 coming out of COVID. It's far higher than normal. Your historical average is probably 15, 16. And that's what I expect us to get down into very soon, sort of a normal average. Right now, it's dropped to 16.5. This was a snapshot in time as of yesterday when the market was at its worst. But I think a lot of the wood has been chopped here. Now, bond prices have also been falling, and that's odd because typically when the stock market falls, bonds are seen as a safer investment and they get bid up. Not this time, because of the sort of quirks of this event. In other words, inflation being the primary problem. Bonds are getting hit just as bad as stocks. This is a widely held corporate bond fund, high quality bonds, down 18% since September, November. That's a big fall. So that's why this feels so bad, because if you've got a mixed portfolio of cash bonds and stocks, both the bonds and the stocks are going down about the same magnitude. And so that's why this feels worse than maybe it did in 2011 or 2020 when we had other types of events that were similar to this. But again, assets that fall in price get cheaper. Okay, so why do you buy a bond fund? Because of the interest that you collect, right? And And interest rates have been sliding for a long time, going lower and lower. And probably some of you can remember mortgage rates under 3%. That wasn't so long ago. Okay, well, bond yields got so low they weren't keeping up with even lower inflation. So that was ridiculous. And so you need to see higher interest yields. We need to see some believable, realistic levels of bond interest. And so that's where we're going. You can see this chart is turning up again, and that means that the interest yield on bonds is getting more attractive by the day. Still got some wood to chop. We're not all the way there yet, but anyway, it's getting cheaper. Now, okay, let's talk about the speculative type investments. The declines in crypto, in EV or electric vehicles, in meme stocks, in IPOs, or the brand new stocks that are coming to market through initial public offering, they've been decimated. So the declines here are far worse than in quality investments in bonds and stocks. And it's our view that these areas of the market do not recover quickly. We think, especially crypto, it's going to take quite a while for that to recover. So we would advise, and we are staying more aligned with quality investments. All right, so we've got this big correction. How did we get here? Let's examine that for a minute. Well, this chart shows retail sales, which is consumer spending in the US, and it shows money supply, which is it's all the money that's in deposit accounts, like your checking savings accounts across the whole country, and CDs. Okay, so you see at the end of this chart, things get crazy at the right-hand side. Everything goes nuts. Well, what happened was when COVID came along, half of the economy had to shut down and hard to spend money. A lot of people were laid off, especially if you worked in restaurants or hotels, cruise lines, airlines. So you get the retail sales falling off the map. That's the orange line. It just dives, right? Well, then the government reacts pretty quickly, actually kind of to their credit, right? And they passed a bunch of stimulus, and they're sending us checks. And there's PPP loans for businesses. And so you see the money supply, or all that money in checking and savings accounts, just skyrocket in response. All right, so then, we're flush with money. We come out of the COVID era where the health concern starts to recede based on, vaccines and the boosters, and people want to get out and spend money. So there's this massive boost in consumer spending. And I can tell you that at one point, about a year ago, the number of shipping containers arriving in the LA and Long Beach ports was up like 20% from pre-COVID levels, meaning that there was just a step function up in demand. So surging demand, okay, and then you get restrained supply, because the global supply chain can't handle 20% more shipping containers arriving in the ports. It can't handle just the massive demand for furniture, for home goods like that, appliances, cars, what have you. So this is a measure of pressure on the global supply chain, and you can see that it's up a huge amount based on what we experienced in recent years. So you got surging demand and you have restrained supply. Well, that's a recipe for inflation. That inflation was also fed by just massive government stimulus during COVID. Anyway, the Fed's long-term inflation target has been in the past 2%, recent past. I think if you look back at the long history of the U.S., my guess is 3% inflation was a better average. But these two lines here, the black and the blue, are measures of current inflation, and you can see they're off the charts. Really kind of, it's a pun, but off the charts. Okay, so and these two measures of inflation, the blue one is the Fed's preferred method of looking at it, above 5%. And when your target is 2 and it's at 5, well, you got to react. And so the Fed's overriding goal right now is we got to bring down inflation. We can't let this thing get runaway like the 1970s. So they are focused on what else? Raising interest rates. to combat that. And that's one of their main tools for policy. So this chart just shows that the Fed has done a great job in telegraphing what they plan to do. They've really laid out a pretty comprehensive plan for raising interest rates and removing some of the stimulus that they gave us during COVID. And so the bond market has been able to respond. And so, if you're going to raise interest rates pretty regularly from here to the end of the year and perhaps beyond, the bond market says, well, bonds need to respond with higher interest yields, and that's what this chart shows. Okay, so again, that the mortgage rates were under 3% in very recent memory now, and now they're well over 5%. And some analysts in the housing market are talking about maybe breaching 6% before the end of the year. Anyway, rates are rising. And so let me pause here and say, that's going to be an issue for the economy. Let's talk about the economy, what they call the macro economy, pros and cons. The pros, as we sit here today, again, consumer spending is pretty strong. Unemployment is very low. These are not debatable items. And there are some signs now that inflation has peaked. I think, if you read my daily market update, I talk about a couple of specific measures of inflation that seem to be coming down a little bit over the last 30 days. And you can expect some of these supply constraints will ease. Inflation was not helped. It was hurt by Russia-Ukraine war and China shutting down Shanghai, 27 million people there, all for like 15,000 COVID cases. And by the way, it's Omicron. Come on. So, but those are one-time issues that are going to recede into the rearview mirror pretty soon. So that's, I think, one of the pros is it looks like inflation is peaking right now. Also, corporate earnings, public companies have to report every quarter how they're doing. And we just got done with hearing from corporate America that things are better than feared. Companies, by and large, are doing a great job given a difficult environment of maintaining, positive sales growth and profit growth. All right, now the cons. Inflation may have peaked out, but it could stay at elevated levels for some time. I mean, we're not going to get down to the Fed's 2% target rate by the end of the year. No way. So that's, it could take time. And so this whole market event that's really sort of it's very volatile for both stock and bond owners. Well, that could continue for a while. The Fed's focus obviously is on fighting inflation, and it's possible that if they keep raising interest rates for a sustained period of time, eventually they end up destroying demand or choking off growth. Eventually someone says, are you kidding me? The mortgage rate is 6%. We're not going to look for a home right now. Same thing with business loans and auto loans. At some point it becomes too high. So those are the pros and cons. Let's use that as a springboard to talk about, what happens in the future. And I think it's all about the landing. In other words, can the Fed bring down inflation without really kind of crashing the economy? And so we'll talk about soft landing, bumpy landing, and hard landing. All right, soft landing. This is the great hope. And I think this was concisely stated by Bloomberg News opinion author yesterday. The Fed could increase rates just enough to keep inflation from getting worse, and then the supply chain and other post-pandemic pressures will recede and excess inflation will disappear. And there are already some signs that that's happening. This is the best case scenario, because what it does is it basically says, gosh, the bottom probably in the stock and bond markets, the bottom is probably in. And now, maybe we can, over the next few months, maybe we can start to recover. But we do need to see signs, concrete signs that inflation is easing. All right, let's talk about the great likelihood, which is a bumpy landing. And I think the biggest tenet here for this camp is inflation has peaked, okay, but it's going to come down. It's going to be sticky, or it's going to come down slowly through the rest of the year and into 2023. So the Fed won't have to enact all of its planned interest rate hikes, but they are going to have to raise interest rates further for some time now. And we might very well avoid recession, but growth is going to be anemic. So in this kind of scenario, you could see economic growth, instead of being 3% this year, maybe it's 2, and maybe next year instead of 2%, it's 1.5. That's anemic, but again, it's still positive. You're avoiding recession, which is the definition of recession is a couple of back-to-back quarters of negative growth or contraction. And then so there's the great fear. Speaking of contraction, I don't think this is likelihood at all, but we need to talk about it. And in this scenario, inflation remains persistent. The Fed struggles to contain it, well into 2023, and finally, higher interest rates and inflation just end up choking off economic growth, and we enter a recession. Inflation is coming down no matter what. That's a certainty. The question is, what brings it down? Is it gradual Fed interest rate hikes and a kind of a improvement in the global supply chain? Or does it take an inflation? Does it take a recession? Because recession is a great cure, a quick cure for inflation, but it will cause more volatility in the stock market. So we got to look at the recession checklist again, and I brought this out last month. It's time to, unfortunately, this is the part of the business cycle when I have to always be looking at this. Again, the two top bullet points: accelerating and problematic inflation and the hostile Fed. You got to check those off. Those are signs of recession. The third bullet point, however, is still very much a question mark. I don't see any concrete signs, looking at all the economic data we monitor, of economic recession. So that would be the next thing we're really focused on, is looking for those signs. But right now, the economy is fairly strong. And then the last two bullets: investor exuberance or just people whistling past the graveyard. I don't see that. And then high stock valuations. We talked a little earlier about how the falling stock market is lowering stock market valuations. It's really hard to say anymore that there's a bubble. I agree that coming into 2022, the stock valuations were a little high, were too high. And you talk about stuff like IPOs and SPACs and crypto and EV. That probably was definitely a bubble. But it's getting harder to argue that now that valuations are coming down. So I don't see, looking at this list, any conclusive reason to believe that a recession is imminent here. And let's talk about corporate earnings growth, because this is really this is the lifeblood of your investments in stocks and bonds that we manage. And so, how's corporate America holding up? The companies that you're investing in, are these companies able to drive growth even in a difficult environment? And you can see that 2021 here, the green is profit growth, and the orange is sales or revenue growth. And this is the top 500 or biggest companies in the US. 2021 was great, but unsustainably high growth numbers coming out of COVID. So you've got to slow down. Well, this year it still looks like 7 to 8 to 9% growth, and that's great. Even if those numbers have to come down, even if we post 6%, say, revenue and earnings growth this year, that's still positive. And then going into 2023, you can see those numbers are still expected to be positive, so that's wonderful. If we can maintain even a modicum of positive earnings, profit, and revenue growth for U.S. companies, I think that really goes a long way to help us stay out of recession. So that's what it looks like at the moment. And I just want to conclude by saying, we're watching things very, very carefully, and we're still fairly constructive, but we are in a bear market, right? So that's why you probably have more cash in your account than you normally would. We've done a little bit of internal jiggering, and there are some sectors I think that can continue to be held, that won't go down another 20%. Eventually we'll come out of this thing, and we need to weather the storm. I mentioned at the top of this webinar that stock market's down 20%. In other words, the S&P 500 and NASDAQ is down 30. This is not new ground. Okay, so just in the recent memory here, 2011, the S&P fell 20%. 2018, it fell 20%. 2020, it fell more than 20%. Of course, that was a crazy once in 100-year pandemic, and that caused a recession. But these other, the other two examples in recent memory here did not. So we'll continue to monitor the situation and be back to you next month with another update. But I want to thank you for watching and for your confidence and trust in us. Goodbye.